Welcome to the Growth Plus Exit podcast, where owners of privately held middle market companies talk about founding, scaling, and exiting their businesses successfully. Learn how to maximize and monetize your business on your own terms. Let's get started.
Hello, I'm Heather Bennett, your host for the Growth Plus Exit podcast, featuring business owners talking about founding, scaling, and potentially exiting their businesses successfully. Past guests on the Growth Plus Exit podcast include Kelly Schrod, founder of Data Vision, Jody Jankowski, CEO of Blackline, and Jeff Janicek, founder of In a Flight. This episode is brought to you by Newport LLC, a team of seasoned C-suite executives who help CEOs of privately held companies grow, de-risk, and exit their business successfully. To learn more about Newport, visit us at newportllc.com or find us on LinkedIn. Before introducing today's guests, I would like to thank David Wilson and Pete Perkins for introducing me to Tom and Stephen. Thank you, David and Pete. You can find more information about David Wilson and Pete Perkins on the newportllc.com website. Today's guests are Stephen Goldberg and Tom Theurkauf. They are the founders and co-owners of Sun Business Valuations, LLC. This company specializes in valuating middle market companies. Sun has emerged as one of the leading players in its field. Stephen the founder, has orchestrated the sale of hundreds of middle market companies and done business valuations for thousands of clients nationwide. He's also a speaker and writer on M&A and business valuation issues and serves regularly as an expert witness on cases involving business valuation disputes. Tom is a vice president at Sun, where he actively manages valuation engagements and supports the investment banking division. He has extensive knowledge of business valuation principles, also completing thousands of valuations for many purposes, including M&A, succession planning, buy-sell agreements, marital dissolutions, partnership disputes, partnership acquisitions, and estate and gift tax purposes. And I think we'll probably get into a little more about how their partnership started as we have the discussion. Stephen and Tom, welcome to the show.
Thank you.
Thanks for having us.
So let's start with you, Stephen. How did you found Sun Business Valuations? What did that look like?
Well, I think it pays to talk about the first company that we founded in 1999, Sun Mergers and Acquisitions. I at one point was involved in a company that handled the sale of companies, owned a company on my own, and then said, I want to get more back into the business of helping people who want to exit and sell their company. So I started Sun Mergers and Acquisitions in 1999 as a firm that represents business owners of lower middle market companies, typically transaction values in that $5 to $75 million range. And we would represent business owners who were looking for an exit strategy by way of selling their company, and we would handle all facets of the sale of their company. We then, about 2 or 3 years later, I think in 2002, I founded Sun Business Valuations, because we recognized there were a number of companies that just needed certified business valuation services, whether it be for transaction purposes and thinking about their exit strategy and business sale options, or many other reasons that had nothing to do with a transaction, like gifting and estate planning, succession planning, partnership disputes or partnership buyouts or buy-ins, divorce, all different reasons that people need to understand the value of their company. So that led us to founding a separate entity, Sun Business Valuations, in 2002, now about 23 years ago. And over the years, we really worked very hard on growing that division to accompany Sun Mergers and Acquisitions.
So talk about those first 10 years. What were some of the bumps in the road as you were building both of those companies? And how did you, what did you learn in that process?
Well, having done M&A for a while for another firm, I thought we would hit the ground running, but it always is nice to think that way. But it was definitely a challenge in the early years. We found that we redefined our model. We had to redefine what transactions we wanted to handle, what size transactions we wanted to handle, because you can't be everything to everybody. And a very key aspect of our development then was also adding the business valuation division, because anyone who is going through an M&A process or doing any kind of planning or growing of their company or bringing in partners needs to understand the value of their company. So starting Sun Business Valuations was very key in our development. Just it was very steady growth and getting involved with the right people. But a key inflection point for us for Sun Business Valuations was when we brought Tom on, and Tom joined us, Tom, what, 11 years ago?
That's right, 2014.
2014. And since Tom has become a full partner at Sun Business Valuations.
That's wonderful. So, Tom, tell me about your decision-making process to join Sun Valuations. Like, where were you at the time? What were you thinking, and how did that happen?
Yeah, sure. So my background is in finance. I majored in finance at St. Bonaventure University. And the first role that I took outside of college was at a real estate investment company, working in their accounting division. And I really didn't like that role. It wasn't very interesting. I didn't like the culture of the organization that much either. And I wanted to take on a role that was much more client focused, interesting work, finance related. I did a lot of research, and I actually specifically wanted to do business valuation at a lower middle market firm. And I contacted many firms in the space. I reached out to Stephen, and he had someone actually leaving around the same time that I was looking for a role. And the timing was perfect. It was a great fit. When I started working at Sun, again, this was in 2014, it was an analyst position. And the valuation division was more of a smaller piece of the company. It was more of something that complemented the M&A side well. And I was providing support in the M&A transactions and also active on the valuation division. And we've been quite successful since then, growing the valuation side. We have lots of relationships with accountants and attorneys. We've really been a trusted partner to those professionals and to their clients, and we've expanded the purposes for which we do valuation work. So not only for sales of businesses and partner transactions, but also tax, litigation. And now litigation is actually a huge component of our valuation side. We do a lot of divorce work or economic damages. And I'm the partner that's really quite involved in a lot of those engagements. I do a lot of the expert testimony as well. But it's been very interesting over these years in having these really meaningful projects with entrepreneurs who are working through some type of transition, whether it's a partner they're taking on or buying out or selling the whole company or transitioning to the next generation that will in a family business that's running the company. So it's been very pleased with this decision.
And thanks, Tom, for highlighting the number of people and professionals involved in these major transitions that companies have. whether, it's a dissolution or they're selling the company or working with me. Like there's so many professionals needed to make sure that that process of M&A goes well. And it's always good to highlight that for business owners to understand, no, there's a lot of people you need to bring in before this next step can happen. So with that in mind, Stephen, from your experience with M&A, so at this point we still have the M&A branch in existence when Tom came on, and it was sounds like it was the bulk of the work then. Um, from your experience, what do business owners need to be thinking about um, from that M&A focus?
Well, I think when someone has a company, in order to really make it most marketable, you want to have there's a few things to think about. Predictability and sustainability of revenue and earnings. How can you create a business where, again, not only is it a profitable business, but there's a good story to be told about the predictability and sustainability of earnings going forward. Putting together a management team where the owner isn't the key cog in the wheel or the only key cog in the wheel, but having a diversified and more depth in the management team is very, very important as well. I think it's also important to understand your objectives, understand what the value of your company is as it's growing. So there's a number of things to consider, but when you're building a business, but to make it really saleable, it has to be more about having a team and having a predictable and sustainable outlook going forward.
So you're talking, I think that's great advice, like having that, that diversified and very strong management team. Do you work often with boards of directors then during this process of M&A and valuation?
We don't when we do many times we will do valuations of companies regularly so people can understand what they're sitting on in terms of valuation. So whether it be the shareholders, the board of directors can understand, hey, what is the value of my company in the event I wanted to do something now? But just as importantly, it also helps people understand, what do I need to do to enhance the value of the company as well? And so many times we're doing annual or valuations every 2 years of companies to really allow them to see. It acts almost like a scorecard for their company and how they're developing as a company and building value.
And I'm sure, Tom, with your background in finance, you're understanding the value of having this additional scorecard along with all of the traditional financial documentation in the process. Is there any unusual piece of, I'd say, financial documentation that you think is often overlooked during the process of M&A or necessary in valuing a company?
So the financial statements, whether they're audited, reviewed, or internal financial statements, whatever is reported as the profit, that may not tell the whole story. There can sometimes be non-recurring expenses that need to be, adjusted for. There could be expense line items, like sometimes we'll see a management fee that's paid to related entities, or owner compensation that, in the event of a sale, could be reduced. So something that can be very helpful is during this valuation process, we review with the management team, with their accountant, the numbers to try to estimate, in the event of a sale, what is the realistic profit that could be realized? What's the real cash flow that could be generated? And it can be helpful to do this on a more periodic basis, so that when you are ready to sell, these types of schedules are already created. So that's something that can be helpful, and it's really more of a byproduct of doing the business valuation on a regular basis. But it can be used in the negotiation process as well. So it can be a very important schedule to reference.
That's excellent. And we're talking about the transition that companies make. One of the transitions that we talked about earlier, Stephen, was your decision to wind down the M&A portion. And so Tom came on before. So thinking timeline wise, Tom comes on, starts working for the company. You've been growing. Obviously, you've got a great team. What happened in order for you to start recognizing the importance of focusing on the valuations aspect as opposed to the M&A part of the business?
Well, the M&A part of the business I've been involved with all in all over 30 years, about 25 years through Sun mergers and acquisitions. And at some point, you look at things and you say, when you make certain decisions, and I just made a personal decision that, while we had a great M&A company, from a lifestyle standpoint and also from a growth standpoint, we felt that the valuation division, we worked very, very hard to build. It's been growing every single year. We're expanding, as Tom said, not only with the various purposes we do the valuation, but we do valuations nationally for accounting firms, financial planning firms, attorneys nationally. And we just saw that there was an opportunity to really concentrate our focus and not dilute and have two separate companies. And having two separate companies, if anyone runs a business and owns a business, they realize it's hard to run one business. But when you have two separate companies, it's that much more difficult. And we just made the decision that there's a lot more, of opportunity here, and we want to just focus our growth on the business valuation division. So going back about a year, little less than a year ago, we made the determination to not take on new clients in the M&A sector. We established some good referral relationships and would be able to hand off to the right parties who can help them. And our sole focus has been on the valuation division, and it's our goal to become really there's many firms in our let me back up for a second. In our industry, there's many firms who do business valuation, but that's just an adjunct of what they do. For example, there are a number of accounting firms that do valuation, and they usually have that one person in their firm that handles valuation, but otherwise their primary business is accounting or tax reporting. In our business now, in Sun Business Valuations, we're one of the only companies in the country that is just focused solely on business valuation. And I would say we've grown to where one of we could be in the top, certainly the top 5 or 10 companies in the country doing this. So we just see that we really appreciate where we brought it to, and we see an opportunity to continue to grow. And we just wanted to focus. And also from a lifestyle standpoint, I just turned 62. I'll tell you my exact age. Just turned 62 the other day. And I just realized that from a lifestyle standpoint, I wanted to also be focused on just one business and not two.
Excellent. And I'm going to ask a question. I want both of you to answer it separately. So I'll start with you, Stephen. What has changed in, we'll say, the last 5 years in M&A, or even the last 3?
Well, I would say there's a lot more uncertainty out there in terms of situations that are impacting businesses. And as such, I found that due diligence is becoming a much more of a grueling process for business owners. Whether it be again tariffs, labor issues, changing technologies, and obsolescence of companies that are not changing. It's become much more difficult to determine what companies are sellable, what companies are going to be successful going forward. How are some of the risk factors that companies are going to be dealing with going to impact the business? So, but listen, there's always people out there looking to sell their business for lifestyle reasons. And there are many strong acquirer groups. Private equity is still very strong. There's a lot of reasons to do transactions. So I'm a big believer that the M&A market is still very strong, but there is a lot more trepidation out there.
Okay, Tom, same question. What's changed in the last 3 years, and maybe what do you see going forward with the M&A market? Because I mean, like the audience for this podcast are business owners and entrepreneurs. If we can help them see what's happened, what is going on, and what's coming, that would be great.
Yeah, I think a counterpoint to Stephen is that there is still a lot of stability. People are still buying and selling companies, and this is an investment that's very much a return enhancing investment for many acquirers. These companies are purchased at valuations where the expected return is much higher than you could get if you were going to invest in the stock market or real estate. So it still is a very attractive investment. And one of the reasons that that's true is many of these business owners, they tend to sell, when they're ready to retire, when they're looking for some type of, like Stephen had mentioned, a lifestyle change. They're going through a transition. They're looking to perhaps de-risk by taking some money off the table. And this is certainly a market where there's liquidity out there still. There still are buyers. There's still an opportunity to sell companies for very meaningful values. But those values, they tend to be still quite attractive for private equity, strategic buyers, et cetera.
Absolutely. Okay, so I know we've talked about the fact that Stephen, you're in this transition with Tom as a partner now, with we'll say sundowning the M&A portion. What does that mean for that business, that company, your employees? How is that process taking place? You said you stopped taking new clients and you're really leaning on your industry colleagues to help with that process. But what does that look like for the employees that are in the situation right now?
Well, we worked, we did convert one person in our M&A division to our valuation company. And we gave plenty of notice during our transactions to the other parties who were just exclusively focused on our M&A division. But there are certain people we needed to, let go because we were not going to be continuing the M&A division. But since we have hired, we now are a 9-person firm in just business valuation. So we've expanded our team on the valuation and just gearing up for our continued growth.
That's such a great answer because so much of an M&A, a before, during, and after transaction success, I think one of the underlying things that sometimes gets overlooked is the amount of communication that has to happen with both parties' employees, if it's a merger or if it's an acquisition, to let them know what's happening, what the time frame is, how they're going to be supported during the process. And that goes to tying, like Tommy had mentioned, de-risking. One of the ways to de-risk these transactions is to make sure that the employees from all sides are on board and are knowledgeable and have been given the information and communicating. So, Stephen, that's a great advice to make sure that you keep that communication going. What have been some of the turning points for both of you since the company started? Any of them like major changes from external sources or internal that have surprised you?
I think a key turning point for us is when we brought on Tom, bringing Tom in. Tom, it was so a dedicated professional for this field, loved this field, and at that point, that's when we realized that what this can be, this division, which was once or in the early stages more of a stepchild to the M&A division or M&A company, we know that this can be a real growth company. And we started bringing on talent around Tom, expanding our marketing, our centers of influence, and as we mentioned, expanding the reasons for valuation, and just really focusing on doing things that we saw that other companies did not do. We saw, for example, most companies out there do not provide, we provide a fixed fee where we understand an engagement and understand what someone's looking to accomplish and more about their business and their valuation objectives. We will provide a fixed fee. Most companies will not provide a fixed fee, and it's an open-ended fee structure, which could be very scary to people working and not understanding what the fee is going to be. Turnaround time. Most companies would take a few months to turn around their valuation reports. And we never understood it because most of our clients are much more time sensitive than that, whether they're doing gifting or estate planning or succession planning or sale. And we really worked hard to have, from the time that we have the information that we requested and have the intake conference with our clients, to have the valuation complete within, or a draft complete within 10 to 15 business days. So things like that really, really allowed us to stand out, really propelled our growth, because once we then work with professionals who are use us for their clients that need these services. Now, whenever they have a situation where one of their clients is getting a divorce, looking to buy out a partner, looking to do estate planning, whatever it might be, they'll think about us going forward. So being able to develop those relationships and do the things that other companies won't do, I think that's been a big inflection point for us.
Okay, so going with that, Tom, what are some of your proudest moments that you're really proud of the work that you're doing at Sun Business Valuations?
Yeah, I think that over these last few years, given the significant number of projects that we've completed, we've really been able to hone in product. Product is so important. As Stephen had mentioned, really any business can be so successful as long as they have a fair price, an attractive turnaround, and a great product. And over these last years, I've spent a lot of time working on myself, taking industry-specific courses. At this point, I'm certified in business valuation through the American Institute of CPAs, the American Society of Appraisers, and also NACVA as well. So I myself and others in the firm, we've really spent a lot of time focusing on the academic side of business valuation and applying that to really honing in on a great product. And more recently, we've spent some time working on some automation. This is a service line that when you're creating a valuation report, some of that process involves copying over charts into Word documents. And we've been really smart with technology in helping to streamline that process. We have great systems with Salesforce in managing, collecting data as well. So we've really professionalized the business over these years. And I think that that's something that's really contributed to our success for sure.
It is really so important to talk about the tech stack that businesses are built on, and understanding that that is a continuous changing process. The Salesforce that's working for you right now may need to be something different at some point based on the growth of the company, which is fantastic. Stephen, so speaking of the growth of the company, what and I'm going to ask you this too, Tom, as well. What is your vision for the company going forward?
Well, our vision is, one of the things that we've done is we made ourselves a national company. Companies are the evaluation process, unlike like real estate appraisal, where many times you have to be on site. We work very, very closely with our companies, our clients, but whether it be through Zoom, sharing, having secure links to upload documents, we're able to work very closely with companies nationally. Our vision, Tom and my vision for the company going forward is to continue to grow the company and really provide these types of services that other companies do not provide. Many accounting firms, they may charge, for example, on engagements where they may charge $20,000 or $25,000 for. We're able to achieve our clients' goals for less than $10,000 for many situations. So we're really looking to continue to provide that kind of differentiation from other companies, but just really continue to grow to a point where and just continue to scale the company. Now we're not involved in the M&A side of the business. It allows us to just focus on business valuation. And I think just more, I think we have a very good model. We have a great reputation, and just being able to now build on that momentum, continue to build out our relationship with companies like Newport, again, accountants, attorneys, financial planning firms, and really be a resource to these companies.
Excellent. Tom, did you have anything to add to that?
Yeah, so thankfully in our space, we have had a lot of success. And part of that is building these great systems to support growth that Stephen had already mentioned. Paid marketing, SEO, email marketing, reaching out to accountants and attorneys, making sure everyone is always very happy with the service, and learning from any mistakes as well. And we do see that demand is there for us. Thankfully, that's not the same for all industries. But it's important to when you're growing to continue to do a great job for your clients. That's something that does limit growth. You don't want to grow too fast. You don't want to just hire a bunch of people. We want to make sure that we are mentoring the people that we have in place. We have a great team that all of our employees have been here for many years, thankfully. And as we add people, we want to continue to create more formal systems for onboarding people and mentoring them, making sure that they're getting the right support. And that's something that is also a learning process for us. We're going from a smaller company to what we're hoping will be a much larger company. And so part of that process, it is we need to make sure we're doing a great job for everyone in our team.
Such a great point to make about that the need for continuous learning. So Tom, how do you stay up to date on the industry? As a business owner, where do you go to find your information about, what's changing, what's new, what you need to be aware of?
So I am a member of several professional groups, and those groups are very helpful. The American Institute of CPAs, the American Society of Appraisers, the National Association of Certified Valuation Analysts, they all send out articles that include trends in the industry, academic research that's ongoing. There is a certain amount of continuing education that I am required to do. Stephen is required to do as well. It's very interesting coursework, and a lot of that coursework is able to be completed remotely these days, which is so helpful. It used to be that we'd have to go somewhere and do these courses live. Thankfully, a lot of it's completed remotely now. So there are so many resources out there.
Excellent, Stephen. So at Newport, we always consider ourselves, and I know we're working with a few of my partners, of lifelong learners. So what do you do to continually learn, to be a lifelong learner?
I do a good amount of reading to be a lifelong learner, and I really find that I learn a lot from one of the interesting things about what we do is we deal with so many different industries, and so by doing that, and during our engagements, we really get to learn more about all of these different industries. So being able to learn continually about the trends in different industries, challenges. Fortunate to be in a situation where we are dealing with such a broad cross section of industries, because we value all types of companies, and whether it be small retail businesses or large hundreds of millions of dollar manufacturing plants, and it varies. So it's just interesting to learn a lot about all these different companies.
I agree. I love working across a lot of different industries because of that fact. There's always something to learn, and it's interesting to see where, what's similar between industries and what's different. So very, very good. So Tom, you had mentioned mentoring the employees at Sun Business Valuations. Who are your mentors, and what's some of the best advice you've gotten from them?
Well, I would say Stephen is certainly one of my mentors because he was my direct report when I, first started working here at Sun. And one of the things that I was nervous to do when I was just an analyst, first working at Sun, was to lead the management interview calls. And, I was uh, just pretty recently out of college, having these calls with business owners. They've are experts in their fields. They are CEOs. They're very successful. They manage 100 plus people, and it was a little intimidating at the time to lead these calls and to be confident, to ask smart questions. And, and part of that process was, listening to Stephen run them. And there was a moment where Stephen gave me the confidence and he said, you just need to take on this responsibility now. You can do it. And I do remember that moment and Stephen really helping me get through that.
That's wonderful.
I just want to say something,
yeah.
right? When we talk about a transition period for our company, around the time that we were solidifying, just focusing on Sun mergers and acquisitions, Tom was a non-equity partner, and Tom now is a full-fledged partner in the firm. And, I think as a business owner, it's important to recognize who is really important to the company and do what you can to solidify those people so they're going to be with you for the long term. And I think whether it be our M&A business, our valuation business, even before Tom became an equity partner, he was a non-equity partner and he was making a lot of money. And I wasn't looking at it by, hey, is he making too much? I'm looking at it like, hey, you want to pay those people who really are helping you grow what they deserve so they're not going to leave and start their own firm or whatever it might be. And I think that's a key to business owners to be able to retain good talent and not be short-sighted, but rather share and create incentives to grow along with the company, both from an income standpoint and perhaps equity ownership standpoint. So that was a real inflection point from our firm, and it really positions us to grow going forward.
That is such an excellent point about really that I think all business owners need to be cognizant of is retaining, top talent. And
Yes.
there's a lot of different ways to do that. I think this is a great example of that. Um, I have one final question, but before we do that, where can people connect with you, Stephen and Tom?
Well, first of all, our website is Sun BV. So that's SUNBV is in businessvaluations.com. They can connect with us. Our office number is 201-727-1300. And my email is Stephen, STEPHEN, at sunbv.com.
And my email
Tom?
is tom@sunbb.com.
Excellent. Okay, so final question, and I'll start with you, Stephen. Uh, what advice would you give to new entrepreneurs, business owners, as they're starting to build their companies, especially in a professional service company like this one? What's the best advice you could give them that you've learned over the years?
The best advice that I can give is to don't try to do too much alone. To bring on people that are smarter than you in various other areas and allow them to help collaborate with you and grow and build together. And just focus on building out a team, and not too many business owners, I think, they become too much of the business, especially early on, and it's not a healthy thing for them personally. It's not a marketable business, and so I feel by bringing in the right talent and scaling is the best thing someone can do.
Excellent. Tom, same question. Best advice for entrepreneurs and people starting businesses?
Yeah, and I think especially because many of the listeners are contemplating a sale, something that's important to keep in mind would be to just run the business like you're going to own it forever. We do see situations where a business, it's ready for a sale. It's a bigger company. There's a lot in place. Then people sometimes they take their eye off the ball at the last minute. Or even worse, they try to position the company too much only to please a buyer. They're making changes that are nearsighted. And really, that's not the greatest decision. You should run the company like you're going to own it forever, even as you are transitioning to a sale.
Excellent advice. I've been talking with Stephen Goldberg and Tom Theurkauf, owners and partners at Sun Business Valuations. Stephen and Tom, thank you so much for sharing today. I really appreciate the advice that you've given.
Thank you, Heather. Really appreciate having the opportunity to be on your show.
Thanks for having us.
Thank you for listening to the Growth Plus Exit podcast, sponsored by Newport, a unique national business advisory firm. If you enjoyed this show, be sure to share, like, and subscribe for future episodes.